On today's episode, we are going to be talking about 8 steps to an 8-figure net worth and creating generational wealth. And you don't want to miss it. All right, so everybody wants to accumulate wealth and build wealth. But if you want to pass on generational wealth, there's certain things you got to do to ensure that that happens, right? So step 1 is we want to establish a living revocable trust. And the reason why we want to establish a living revocable trust is because that is going to set up the entity that can own our assets, be the beneficiary of our assets, and ultimately dictate how those assets are going to be distributed. Because the challenge is, the reason why generational wealth doesn't happen is not just because people don't have the money, but because the next generation squanders the wealth versus being able to have it controlled by a trust, owned by a trust, right? You don't own it as the individual, but this entity owns it and can ultimately say, when my child turns 21, we want to do this. When my child turns 25, we want to do this. If my child achieves this milestone, we want to do that, right? So that's the first step in the process that you want to execute on. Create a living revocable trust and let that house your assets so that the trust can dictate what happens even when you're not here. Step 2, invest in the stock market, leveraging what I like to call the Burger King investment strategy. I've talked about this ad nauseum in other videos and also in the classes that I teach, but I'll give you the bird's eye view approach to this. Basically, what you want to do is you want to look at companies like Fidelity, Charles Schwab, Vanguard, right? The big heavy hitters. All of them have their own brand of an S&P 500 index fund. All of them have, and the market in general has a bunch of ETFs and index funds. And for those of you who don't know what those are, think of it as like the mall in your favorite city that has hundreds of stores. Instead of figuring out which store is going to do well, you just say, the heck with it, I'm going to own the whole mall. And even if a few of those stores don't perform well, sure enough, you're still going to be okay because you own the entire mall, right? That's essentially how ETFs and index funds work. But you can take it a step further. You can look inside of those ETFs and index funds and see what are the investments that these institutions selected. They believe in all of them, right? But just like your favorite mall, there's going to be some stores that are really doing really well and some stores that are probably performing a little bit average, right? So what you can do is do some research and see what are the top performers in this fund and make a decision on if you want to own a handful of those in addition to owning them inside of the mall. No different than you would see a standalone Apple store and you would see an Apple store inside the mall. What that will do is it'll give you a chance to have better returns than just the index fund itself, because now, right, you have more ownership of the heavy hitters in addition to the broader diversification of the entire portfolio. Following this strategy has allowed me to outperform the market for the past 7-8 years in a row. So that's step 2. You want to set up that portfolio and then you want to have the trust also own those assets. Now, step 3, we want to identify cash flow producing assets, right? And if you have access to capital, access to credit, ideally lines of credit that might give you rewards or incentives for leveraging it, like a cashback rewards card, you want to use that to acquire an asset. Maybe use it for the down payment on a real estate property, right? I know you're thinking like, why would I use a credit card for the down payment on real estate property? Well, I'll tell you why. Because if you were to just use the money from your bank account, that $10, $15, $20, $30,000 is just going to exit your account. And then that's the only benefit you're going to get from it. If you swipe a card for $30,000 and get the cash back rewards, right, that's going to give you more capital that you can use towards the purchase of more assets, and you're going to get rewards points for that, right? So you probably can use either the rewards points for like a lifestyle benefit, or you can get the cash back and use that to acquire more assets, right? All by just using the card instead of using cash in your bank account. But then what you're going to do with the next step is you're going to take that cash flow producing asset, right, that you just acquired with the credit card, and now you're going to borrow against the value of your portfolio that you just created, because those same institutions, Charles Schwab, Fidelity, M1 Finance, they will allow you to get a line of credit based upon the value of your portfolio that's collateralized by your portfolio. So for example, let's say you have $100,000 invested, they might give you a line of credit of $30,000 to $50,000 or 30 to 50% of the portfolio value, because they can see that you have an asset that you can collateralize. No different than if you were in real estate and you got a home equity line of credit. Why is this a tremendous benefit? Because now that portfolio can grow and thrive without you having to worry about selling investments to acquire new ones, right? So what we're going to do is we're going to borrow against the value of that portfolio, and we're going to pay off that credit card, because the interest rate on the credit card is going to be substantially higher than the interest rate that you get for the line of credit on your portfolio. So now the credit card balance is zero. You got the cash back rewards that you can benefit from, that you can use to buy more assets, right? And now you have your investments that are still growing and thriving, and you have an outstanding line of credit that you use to pay out the credit card, right? But remember, we use the credit card to buy a cash flow producing asset. So the next step that we're going to do is we're going to make sure that we reinvest the cash flow from the asset that we acquired, and we're going to invest that cash flow back into the portfolio minus any small debt service that you have, right, for the money that you borrow. So for example, if you got a line of credit for $15,000, and let's just say 7%, that's going to be just north of $1,000, I believe, annually, right? And so now what you can do is, right, if you have a real estate property that you put $15,000 down on, that's probably going to get you a property that's like around $430,000, which will net out somewhere around, give or take, about $14,500 a year in cash flow. So now you got $14,500 in cash flow. It's only costing you a little over $1,000 to service the debt. Then you simply reinvest the difference into the portfolio. Why is that powerful? Because remember, now you have your investment portfolio that's growing and thriving, right? You were able to not sell any investments and leverage the account to go buy a cash flow producing asset. Now that cash flow producing asset the cash flow is being reinvested into the portfolio, and now it gets to benefit from the growth as well, right? Not to mention, you also got the cash back rewards that you can use to buy other investments. All right, step 7. This is a critical step in the preservation of this whole strategy. So in this process of borrowing against the value of your portfolio, the great news is that you never sell your investments, which means you never get taxed, and it never creates a taxable event, right? But all you have is the outstanding line of credit that you have. So assuming you keep rinsing and repeating this strategy for years, eventually, right, you're going to want to pay this thing off, right? But you don't really need to pay it off until you die. So how are you going to pay it off? What's the best way to pay it off? You're going to get a life insurance policy, right, to make sure that it can cover above and beyond what your family's needs are going to be in your absence, plus being able to pay off any outstanding loan that you have or line of credit that you have against the value of your assets. So that way now the tax-free money you've been getting your entire life is now going to be paid off with tax-free proceeds from the life insurance policy. Because the assets were in a trust, your children are going to get a step up in basis, or whoever inherits your assets are going to get a step up in basis, meaning, right, they're going to inherit the assets at the new value, right, not the value that you originally purchased it, which means now they don't owe any taxes on it either. Gotta know the rules of the game, people. Okay? So you get the life insurance policy. The life insurance policy pays off the outstanding line of credit. Now your heirs own the asset free and clear, right? And as a result, now they can run the same strategy and do it all over again. They can access the line of credit, and they can do what they need to do, right? Now here's the last step, and this is probably the most important step as it relates to creating generational wealth, okay? And that step is you want all of the members of your family to get life insurance policies that are owned by the trust, right? So now the family can borrow from the trust, right? We don't want to give them assets, because if we give them assets, that means we're going to sell the assets. And if we sell the assets, we're going to experience a capital gains tax, right? So we're going to allow them to borrow from the portfolio. And as a result, or borrow from just the assets that we have. And now what happens if something happens to them, because they have life insurance policies that the trust owns, all the money they borrowed while they were living to grow their businesses, to go to school, to do whatever they wanted to do, right? They were getting tax-free money because it's loans, and the IRS does not recognize loans as income. And a matter of fact, they will actually give you a deduction on the loan interest that you have. So when you're borrowing money against the value of your portfolio and you're making those interest payments back, you can deduct that loan interest on your taxes. Did I also mention that cash flow that real estate property is going to produce, you can do a cost segregation study and advance all the depreciation in the first year and wipe out the tax liability associated with the income? My goodness. This is how you build tax-free wealth. These are the 8 steps. I'm gonna have my team list them on the screen for you, but these are the 8 steps you need to follow in order to build an 8-figure net worth and build wealth tax-free. All right, guys, thank you for tuning in to another episode of Financial Freedom Fastlane. And remember, the quicker you get to your dream life, the longer you get to live it. Freedom is for sale if you're willing to pay the price. Peace.